Invoice factoring. What is it? How does it work? And how can your business use it today so that you can collect unpaid receivables in 2 business days, 3 business days, instead of having to wait 30, 60, 90 days to collect payments from work that you've already done or products that you've already shipped? Invoice factoring is a multi-trillion-dollar industry. I'm including businesses across the US, the UK, Europe, and Asia who use this financial tool not as a last resort, but to increase their working capital so that they can scale month on month by being able to have their cash on time and purchase more raw materials, finance more contracts. So as we can see, it's actually a $3.6 trillion industry, and this was a 2024 estimate. And every year, this industry is growing at about 8 to 10%, which is pretty standard. Now, this is a frightening statistic. We see that we've got over 100 million invoices factored globally each year. These are the 6 most cash flow constrained industries that I've seen in my experience. For those of you that don't know me, my name is Benjamin. I'm the founder of Funderbear. We are an educational brokerage that connects business owners to honest working capital so that they can purchase assets, they can receive payments, so that they can invest in stock, they can invest in equipment, machinery, software, hiring to grow their business. We are nerds for business, and this is what I love talking about, even on my weekends. So the most cash flow constrained industries, these are the 6. It's going to be commercial construction, where you've got 30 to 90 day payment terms. It's going to be manufacturing, where you've got long production to cash cycles. It's going to be staffing and HR, where your clients need to be paid every week or bi-weekly, but your clients only pay you every month. It's going to be transportation, so that's freight brokers paying you slowly. It's going to be healthcare with insurance reimbursements lagging. It's going to be wholesale and retail, and then also professional service firms like IT or consulting. And for manufacturing, I'm also going to include oil and gas companies in that bracket. Factoring is one of history's oldest financial tools. It is crazy to me how little companies know about invoice factoring. Most of them will take on a merchant cash advance, or they'll take on debt, they'll take on a line of credit that's revolving so that they can finance their raw materials, so that they have enough cash to take on the next client without feeling stuck. And it's a shame to me that not many people know about invoice factoring. The market adoption rate currently is around 9%. That means that 91% of businesses that could benefit from factoring aren't using it. And it's sad for me to see, because it is a much better alternative to taking on debt, taking on loans, taking on lines of credit, using your company credit card. So let's go back now to 1754 BC, the Code of Hammurabi. This is in ancient Babylon, where we have recorded early forms of trade credits and receivable advances between merchants. If we fast forward around 3,200 years to the 1600s, we've got English textile merchants who used factors as agents to sell goods and advance funds before payment arrived. This is a direct ancestor of modern factoring. So this is when we started seeing manufacturers, producers of goods using factoring as a service with agents or brokers. In the 1800s, the practice spread to American textile and trade industries. So from England, it started becoming a popular financial tool in developing America. In textile and trade industries, where factors became essential financiers for importers and exporters that built America. And today we've got invoice factoring as a mainstream multi-trillion dollar global financial tool used by businesses of every size, from startups all the way to Fortune 500 companies. Now, if you are currently in a position where you're thinking of factoring, or maybe you've used it in the past but you're not consistent with it, and you're using a line of credit, or you're using the company credit score, a company credit card. I'm going to break down the core differences between a traditional loan and invoice factoring and which one is best for your business. With a traditional loan, you're often having to deploy collateral. So you're risking your assets, you're risking your warehouse, you're risking your plot of land, you're risking your building, your office, you're risking your machinery, maybe your trucks, your equipment is on the line. Whereas with invoice factoring, you don't have any collateral because the invoice operates as security. And the chances of approval on that invoice being paid out early is entirely dependent on the credit worthiness of your customers, not you. Adds debt to balance sheet. This is point number 2. Yes, a traditional loan is going to increase your liabilities. It's going to devalue your company. You're going to have outstanding interest. Whereas with invoice factoring, it's an advance. It's not a loan. So the way it works typically is you'll get 85-90% of that invoice paid out up front. So if it's $1 million invoice, you've got $900,000 coming in, and that remaining 10% is collected either after the 30, 60, or 90-day periods, and you get paid that remaining 10% minus a small fee. And that fee ranges from 0.5% all the way up to 3%. So you're not taking on any debt. You're not taking on any interest. It's just a simple fee. And I like to think of it like a credit card fee. Like when you tap your card, there's a little fee that comes off, or when you transfer money through wire, there's a little fee that comes off. So it's kind of like a transaction fee, right? Credit score driven. Number 3, traditional loans are heavily, your score decides how much your business qualifies for. Whereas with invoice factoring, it's entirely dependent on the credit worthiness of your clients, on their reliability to pay outstanding invoices. So it's best to use invoice factoring when you've got repeat clients, not once off, repeat, because the invoice factoring company can then look, oh, this guy pays you on average every 50 days or every 60 days, and he's done that 3 times in a row. So I know that this invoice means something. Approval speed. Traditional loans, there's a lot of background checks that they need to do on the directors and collateral and credit score and all that. So it can take, 1 week, 2 weeks, 3 weeks, 4 weeks, sometimes even months to get approval. Whereas with invoice factoring, you could get your invoice advanced in as little as 24 to 72 hours. It can really happen that quickly. And the final point here, grows with your business. Traditional loans are fixed, they're limited, you've got to reapply each time, and it's often tied to your internal revenue. Whereas with invoice factoring, it scales with your invoice volume. We actually had, through our partner Outline, we had one client who had a staffing firm who scaled with Outline from $1 million per year all the way to $10 million per year. Like, is that not a beautiful story? Fantastic. So here's how you can apply, right? So you can qualify for $30,000 all the way up to $5 million, and here's what you need. For US-based businesses, these are the 6 typical qualification benchmarks for invoice factoring. Number 1 is your invoices need to be to other businesses or to the government. Number 2, your invoices must be unpaid or outstanding for a service or for a delivered good. So a service could be an IT firm, and a delivered good could be a manufacturer who's produced furniture. Number 3, creditworthy clients. Your clients, not you, need to have reasonable credit. That's what gets assessed when you are in the pre-approval stage. Number 4, a volume above $30,000 per month. Most factors start at $30,000 per month in invoice, and the upper limit scales all the way to $5 million per month. So if you're processing, let's say, $800,000 per month in invoices, you could comfortably qualify. Number 5, no existing lender can already hold a blanket line over your accounts receivables. And number 6, business is operating. You must actively trading. This is not for pre-revenue or fully dormant or startup businesses. So if you wish to apply and you're ready to get your invoices funded, you can apply through our partners at Outline. I'm going to put the link in the description of this video so that you can apply directly through us, and your application will be prioritized because of our relationship with Outline. They have factored over $1 billion in invoices. They've got 68 5-star Trustpilot reviews and a ton of reviews on Google. Altline was established in 2013, so they're over a decade old, and they're actually one of the very few factoring companies that's backed by a bank. So Altline is actually backed by the Southern Bank, and that bank has been around since 1936. That bank is almost 100 years old, and now they've got a separate service facility known as Altline, which supports, freight companies, manufacturers, oil and gas, IT firms, staffing firms, etc., with invoice factoring as a service. But thank you so much for watching this video. I'm really passionate about the subject. I hope you learned something about how invoice factoring works, the history of it, how big of a market it is, and how it is much better. It is way superior to taking on traditional business loans and business credit. But there is also a lot that you need to get through in order to comfortably qualify for it. So you can apply with the link in the description through Funderbear, and we'll get you in contact with one of the senior members at Altline so that you can get approved in 24 to 72 hours. Thank you so much for watching. Take care of yourself and be blessed. Bye for now.